Okay. So people are slowly connecting. Welcome everyone to today's webinar. So it's the last, but probably not least, of the year. And today the Next Gen is really happy to have the luck to host Keith Flury, so head of coffee research at Sukden, and Zahraa Assaad, quantitative trading analyst for Sukafina. In this very volatile moment, I think their insights are very important to take note, and hope they will shed some lights on the current market circumstances. And without further go, I think Keith, we will start with you, and we give you the floor.
Okay, thank you very much. Let me share my screen. Okay, you should be able to see that now.
I think it's loading. Yes, perfect.
Okay. I would like to thank the SCTA for inviting me back. I hope to offer you some insights today on the market, supply and demand, and what we have seen over the last couple of months. I have a half an hour to do this, so I won't be able to go into too much depth, but going to pick and choose some interesting topics that are affecting us and are driving price at the moment. First, let's take a step back and look at how we got to where we are now. That should firstly be the balance sheet, and this is what we're looking at the moment. It is the supply and demand on a seasonal basis, broken up by Arabica or Robusta. Clearly, you can see that we are in 2024-25 in the midst of the fourth consecutive deficit. The global production cycle of coffee has really not been able to keep up with demand. Well, I say keep up, but demand, as you see here in blue, has actually been rather stagnant. It's not been able to cover demand. And what we have had in an accumulated basis really is 20 million bags of deficit over the last 4 seasons. Should be noted that I have not included the 25-26 season here. While the market is looking very closely at this, and it is key clearly for the flat price and structure, it is a little difficult at this moment to pinpoint. I will try to go into more depth later, but this just gives us the situation as we have it now. Let's say it's a historic perspective. The next thing to note, as I mentioned before, is that from 2021 to 2024, we really didn't see much growth in demand globally. What we have at the moment is a relatively small deficit in Robusta, in a vacuum that I don't think would be much of an issue for the market. But clearly it is yet another nail in a stake, let's say, that has really driven this market higher. And we are interestingly in a market that has initially had an issue with Arabica. Clearly, the 2021 frost and drought reduced that supply, created that major deficit. That transitioned into a Robusta issue. And now I think we are actually transitioning back into an Arabica issue. So this this deficit cycle that we are going through at the moment has clearly had an impact on the inventories around the world. Here you have the big graph, consuming stocks. I have taken the European, Japanese, and the American stocks, or what I assume the American stocks are, and aggregated them together. Included here also is the certified supply. You can see quite clearly the reduction in inventories. It really has been a scale of nearly 10 million, a little over 10 million bags since the peak, all the way to October 2024. And the absolute level of inventories overall globally in the consuming world is at a 25-year low, probably at levels we haven't seen since the mid-90s. Now, it should be said, though, that quite a lot of this was planned, in the sense that the market is giving us the indication, it's at least giving trade and roasters the signal that they shouldn't be holding inventories. With the inverse that we see, stocks, spots are in many ways, and some people having described them to me, poison, because they cost you money, and quite a lot of money potentially. In the upper right, you can also see the expectation and what we have realized with regards to the inventories at origin, also a significant reduction back down to levels that we haven't seen for over 25 years. So as we would expect with such deficits that we've had over the last couple of years, we have run down the inventories. It should be noted that coffee actually generally has large working inventories if we look at it compared to other agricultural commodities. This is a function of the on-off cycle that we often realize in coffee. It is a function of an Arabica market that is generally in carry, or at least for the last 20 years it has been in carry. And so stock levels in coffee are high, but that's no longer the case, which means that the buffer inventories are low, risks are higher, and that generally in agricultural markets means that volatility is going to increase, which is clearly what we have seen on the market. The market, and here you have the Arabica and Robusta price, both in cents a pound below, as well as the arbitrage between them. And in the upper right, you see an indication of the structure. This is the roll yield if you are along either one of these markets. Clearly, as I mentioned before, the dynamic with regards to it being an Arabica issue resulted in the arbitrage moving out to a very high level. You can see that in this bump up here. Then when it shifted to being a Robusta issue, the arbitrage shrank to extremely low levels, bottoming out at 20 cents just in September of this year. That didn't seem so sustainable, and has reacted very quickly in the last couple of months, blowing out quite considerably as the Arabica market has finally responded to a Robusta market in 2024 that was leading both of these prices, I think. The deficits and reduction in inventories has resulted in the structure, as you can see upper right. While Robusta has had a number of occasions where we have seen deficits or we have seen inverses, some of which were squeezes, some of which were real issues with regards to supply. Arabica generally has, for the last 20 years, as I mentioned, been in a carry market. And so it has been a little bit of a new paradigm for trade, industry, and everybody else involved to understand and work with a market that is as tight and in an inverse as it is now. Taking all of this into consideration, then, you note that over the last 7 weeks, the price reaction, the price action has been quite significant. We have realized 50-year highs in Arabica, and clearly we realized absolute highs in Robusta a couple of months ago. Now I want to dive into what the market is looking at the moment and how we can take the outlook moving forward as an indicator of where we should go from here. It's going to be difficult for me to foresee all of the factors in the coffee market, but I'm hoping to give a little bit of a perspective. First, and clearly, let's talk about the Brazilian supply and crop. There have been three, call it deficit cycles in the Brazilian production. Here we are looking at the total production out of Brazil, Robusta and Arabica, versus what we would anticipate. And what I mean by anticipate is generally an expectation of trend. You can clearly model what the crop should be. This isn't full potential, mind you. It is simply what the crop should be if we realize average temperatures and average rainfall. Now, generally, there is always going to be off and on dynamics with regards to the supply, but it has been a relatively historic one recently. In the mid-90s, for example, 21 million bags of production were lost due to a frost. Between 2014 and 2017, a drought in the Arabica region in the beginning and a drought in the Colonial region in 2016 resulted in a 19 million bag reduction in the expectation of production. And at the moment, we are in the midst of a 30 million bag lost crop. Really, it's been frost, drought, drought, drought. And again, I'm not including here the 2025 crop, which may or may not make this situation even worse. This is clearly a systemic weather dynamic, weather climate, and we still are not out of the we're not out of the tunnel yet, let's say. For the 2025 crop, our team is still on the field. You can see some of their survey points here in this map to give you a little bit of an indication of the kind of tours that we are doing. We're anticipating to have most of the data done before Christmas, and probably a finalized crop number in the beginning of the new year. What I am able to give you, and I hope this is at least somewhat supportive, is a little bit of a range. And what we think is that the Arabica crop should be somewhere between 37 million and 41 million. Conilon looks very good and should be somewhere between 25 and 27 million. And in aggregate, a 62 to 68 million bag crop is anticipated for 2025. Let me put it another way. I have a 90% confidence with a 5% error rate that the crop number will be between 62 and 68 million bags for 2025 as per data today. Now, it's very likely or potentially likely that that dynamic will change if weather changes or we have to make adjustments to conversion yield, et cetera, et cetera. You will note in the marketplace quite a number of expectations, and I would say a relatively wide view on what this outlook for 2025 will be. My view is that it is extremely difficult to come up with a production forecast for Brazil in general, and this year it is even more difficult. I'm not going to say impossible, but it is extremely hard. That's why probably every market expectation that you hear, you probably should have a range of at least 5% on both ends, maybe 10% depending on what they think. The market in general, though, I would say, and these are not all verified numbers, and there is quite a bit of circumstance and hearsay to these figures, but I would say that the market is generally somewhere between 34 million bags in Arabica and 43 million bags, high, low, 34, 43 Arabica, and 23, 27 Conilon. Gives you a range of 57 to 70 million bags of 2025 crop. It's a 23% range, which is massive. I can only say, again, that the conditions that we have lived through over the last couple of years give us a relatively unprecedented case this year, and it's going to be very difficult. I would also say, and this may be somewhat controversial, is that this market currently is not trading on expectations yet for the 2025 crop. That is, I think, the commercial short and the commercial long may be trading or may be selling or may be buying, depending on what their view of the 2025 crop is. But the expectation of 2025 as per an absolute number has not been the reason we've had the market move we have had over this last 7 weeks. To put it another way, I think trade house or third-party researcher crop numbers are not the main driver of this, and at the moment they are noise. Everybody realizes that next year's crop will be lower. It won't be a giant crop, but trying to distill exactly what that number is very difficult. And the market, I think, is trading on more a function of the fact that we have no commercial selling and less a function of people trying to nail down exactly what this 2025 crop is. That dynamic of noise, which is like two children playing on social media, makes a lot of noise, but it doesn't make a lot of impact, is something that we're going to have to deal with over the next coming months as we continue to get more and more expectations coming through into the market. But again, I think this market is trading on something a little bit more a function of paper flow, and I will talk about that in a moment. First, I'd like to transition a little bit out of supply and look at demand. But first, we're going to look at the dynamics of the 2025 crop with regards to the overall balance sheet. I showed you that in 24-25, we have a small deficit, and that's the fourth consecutive deficit. What will 25 26B. Now, this is a scenario table that allows you to take the crop number of Brazil for next year, which I mentioned market range of 57 to 70. Here's the range of 56 to 72, and an expectation on demand, an important dynamic which I'll talk about in a couple of slides. If we assume that Arabica production and Robusta production grows by 2.5 million bags from this season to next season, a big assumption, but it's very difficult to foresee what those crops will be at this point in the year. And we take the differing numbers of the Brazilian crop, we get a little bit of a perspective on what we should see with regards to surplus deficit. I'll give you an example. If it's 64 million bags of Brazilian crop, and I'm aggregating them here because it's very difficult to see where demand will be with regards to Arabica Robusta, and we have zero increase in demand from 24-25 to 25-26, you would realize a deficit of 3 million bags. Conversely, if it's a 70 million bag crop and zero demand, you would realize a surplus of 3 million bags. If you run a number of hundreds of scenarios and simulations, it comes out to an average of about 1.5 million bag deficit, which isn't so helpful because it's very theoretical. But this gives you a little bit of an indication on where we are perspective-wise with regards to the crop outlook. The problematic aspect to this is that if it is a deficit, the world buffer stocks, as I have showed you previously, are extremely low. It is definitely debatable on what kind of level deficit 25-26 can realize and still have enough coffee in the supply chain, etc., to realize a efficient market. But we could be in some issues depending on what we think about that crop number and demand. Now, demand is a very interesting factor and one that is often overlooked when we are more focused on the Brazilian crop number. But let me look at it a little bit closer now. Demand in the consuming world, and clearly I am focusing on Europe, Japan, and North America here, in many ways looks as though it peaked in 2019. Now, that doesn't necessarily mean that demand won't grow again and reach those levels someday in the future. But the demographics, especially of Europe and Japan, certainly the price at the moment, and a number of other factors really have impacted the sort of expectation of demand. Working from home, the consumption shifts that we've seen since COVID, et cetera, et cetera. If I look at the bottom graph, which is the global consuming disappearance on a 12-month basis, and I've just overlaid here the retail price of coffee in the United States, you can see quite clearly that since 2009, it's been a very straight, relatively flat, not flat, but it is certainly not trending up with regards to consumption. Now, producer consumption is growing, but it's going to be an interesting dynamic in 2025 when the producing world realizes prices they've never seen before. The upper graph, for example, is the price of coffee. It is ground coffee at the supermarket in Brazil. And you can see that for the last 20 years, coffee prices have been trending higher, but it had really been the last 4 years where we have seen a parabolic move in these retail prices. And from what we hear, 2025 will increase these prices even more. We have seen reductions in demand in Brazil before, mostly a function of economic crisis. I can't say that I have seen demand loss in Brazil because of prices, but we haven't really seen what we are going to realize in the next year before. So demand is an interesting one in that we're going to really test the elasticity, the price elasticity of demand for coffee, I think, in 2025. It could be a function that the consuming world stays stable and we may see some loss in the producing world. But it's also clear, looking at historic perspective, that the consuming world also can lose demand. This is the United States demand. I'm choosing the United States only because the data is very good with regards to historic figures. And you can see over the last 115 years, and I'm specifically talking about the 1950 to 54, the 1974 to 76, the 1994 to 1997, those periods of high prices reduced demand in the United States to different levels and at different ways. And there are definitely different things going on in each of those cases to make them unique. It's notable that in 2010-11, when we had another price spike, the demand didn't drop in the United States as far as we can see. Clearly, there's always going to be shifts in stocks, but what I've done here is I've taken the 3-year average to try to net out stock changes. And it shows me then that the price dynamic of 2010-11, when the New York market went to $3.06, wasn't enough to reduce overall consumption in the United States. But in 1994-97, it was. So I don't think prices at the moment are necessarily reducing demand in the United States. But we have seen precedent for that to occur in the past. Now I'm going to transition out of the supply and demand dynamics and move a little bit into the paper to talk a little bit about what I think is factoring into in a major way with regards to flat price. And it really comes down to the amount of liquidity that are in both of these markets. Now, liquidity is a misnomer in the sense that there's always liquidity available in futures markets because you can't do anything in a future without having somebody on the other side along in the short. So there's always liquidity, but liquidity comes at a cost. And the cost of liquidity in some ways can be measured by how much our commercial long friends are paying in order to maintain or grow their position. And the one way to look at that on the opposite side, the commercial short, is to try to understand exactly how much hedge flow should be realized in each of these markets. Now, this is a very theoretical and difficult exercise to pinpoint, but in the bottom graph, you have what I think is hedge flow from origin into the New York market. And you can see clearly that the hedge flow over the last couple of months has dropped, and the expectation for the coming year is low relative to the averages that we've had over the last year. This is a function of a number of things. Most importantly, Brazil, really the only Arabica origin that can sell forward, backward in some ways, and has the volume to really offer a huge amount of liquidity on the short side. Now, I think the Brazilians have sold all of the old crop. I think they are not selling very much new crop for a number of reasons. I think they're very well capitalized. So selling now is a little bit more patient with regards to the best store of value at the moment is coffee. With more Arabica being used internally over the last 6 months, I think there is less hedging being put down that way. Now, also, an aspect of this dynamic is, of course, the trade. Trading is dealing with quite a number of issues, most specifically cash issues. The marketplace as it is now, the cost of capital, means that trade is struggling. Now you see that in a number of places, I think, and whether that means hedge lifting, which is very difficult to pinpoint, but probably has occurred over the last 4 months in both Robusta and Arabica. We've also seen the dynamic of default risk. Maybe trade isn't willing to go into business simply because of the default risk. That really limits then the potential selling forward, and that reduces the hedge flow dynamics. Volatility, the high price, etc., all of which is impacting that. And if you look at the upper right, you can see the relationship between what I think the commercial hedge flow is on a 12-month basis in black, and what we actually are able to measure from the COT, EFP, EFS dynamics, which, you know, these figures are not matching up perfectly, but there is definitely a trend and a pattern there. So if we take that dynamic from the origin and move it into the actual exchanges themselves, it's pretty telling that since April, the market is up $1.05, but the commercial short position is actually 20,000 lots lower. The commercial positions generally are passive, which is what we think in general. 90% of the price movement on a weekly basis is proved in the COT to be a function of speculators. But that 10% that is driven by commercials can be very important, because when somebody needs to buy the commercial long and there is no liquidity, the market makes major moves. And here I've broken down a number of rallies we have seen since the mid-90s. You can see the movement in New York, for example, in 1997, $1.62. If I inflate that, or if I adjust it to today's money, that's $3.42. That happened over 11 weeks. And we saw that the commercial selling, actually, the position of the commercial short was negative 9,000 lots, which means that the market moved up $1.62, but it didn't encourage, or it didn't prompt more selling, simply because the market either was out of coffee to sell, or it couldn't deal with the high prices, as is similar to this case. Now, previous to this, in 2014, for example, when the market moved up $1, we saw 58,000 lots of selling from the commercial short. We saw 20,000 lots of commercial selling from the short in 21. We saw 10,000 lots in 22, when the rally based on logistics was up 66 cents. Over the last $1.05, we've seen no incremental increase in commercial selling, even with a speculative position that has really been relatively minor. It's only grown by 2,000 lots. We see the market clearly is moving, and this is clearly a function of that liquidity issue that I am mentioning. And here you can see it as a kind of scatter plot. In the upper here, we have the London market, and then the bottom, we have the New York market. The New York market, this is every weekly change in the commercial long and the flat price since 1988. And you can see these two red dots. This red dot is the 1994 frost, and this red dot is the 2021 frost, when the market moves very quickly to reprice based on a supply shock. The black dot was last week, when the market moved very quickly, not to reprice a supply shock, but needed to reprice the dynamic of how much selling was available in the futures market. And that was very expensive. So the the commercial long position didn't increase significantly. It only increased about 2,500 lots. But buying at a market that's up 40 cents is significant enough with regards to the signal. And clearly, with the speculators basically being passive, it was the commercial long driving this market in a vacuum with very little selling. Now, with my last 2 minutes, I'm simply going to say that the coffee market is in a bit of a transition. We have a number of factors that are influencing us, and while I think the paper aspects of it, which I've just gone through, are very important with moving flat price, there are a number of other things, including the cash markets. And clearly, we have seen the mild cash markets fall off significantly recently. That is everywhere but Brazil. This is clearly going to change the dynamic potentially of the certs. We've seen export flow out of Brazil to certified warehouses over the last couple of months, suggesting that the certified stocks are going to increase. This is clearly a bearish dynamic with regards to structure and potentially flat price. We have seen demand be a very, very volatile issue over the last couple of years. And whether or not demand is already being impacted by the prices is difficult to know. But as it is a lagged indicator, it doesn't necessarily drive the market. But I think this year it will be extremely important, because it's going to be the one that potentially frees up some of that liquidity. And of course, we have the dynamics in the cash market, such as the index selling that we're anticipating. The New York market is up 73% in 2024 year to date. That suggests somewhere around 15,000 lots of selling in Arabica. And there's always the dynamics of macro, the FX. I can say that the New York and the London markets have not correlated very much with outside markets in the last 2 years, because fundamentals have been driving them. But that doesn't mean it won't be the case in 2025, when I imagine that the macroeconomic situation will be quite volatile. With that, I would like to thank you, and I will pass it back then to our moderator.
Thank you so much, Keith. I think the insights you presented were really, really good, very interesting, and you made it with the Keith touch. So that was great. If anyone has a question, you can, of course, use the Q&A box on the bottom that we will treat at the end of the of the session, and we're also recording the webinar. So thanks for this fundamental outlook, Keith. Now we will give the floor to Zahraa from Sukafina, that will show us a more technical and chart approach to the coffee market. So Zahraa, the floor is yours, and Keith, thanks again.
I will start by sharing my screen. Can you guys see my screen?
Yes, not yet on the presentation mode, but we can see it. So perfect. That's great.
Hello, everyone, and thank you, SCTA, for having me, and thank you for attending the webinar. I'm Zahraa Assaad, the quantitative trading analyst at Sukafina, and today I'll be presenting about technical analysis for the coffee futures market. I'll be diving into insights and strategies. Now, before we dive into strategies, let's go over the key market players. Now, broadly, we look at the market players in two main categories: commercial players and non-commercial players. Commercial players are players who hold a physical position in the coffee market. They trade primarily to hedge risk. Their job in the market includes managing risk to mitigate exposure, providing market stability, and reflecting supply and demand signals to research into actual production, consumption, and inventory levels. They include producers, roasters, exporters, importers, and trade houses. As for non-commercial players, those are traders who trade to speculate and invest for investment purposes. Their job in the market provides liquidity, enhances price discovery, and drives volatility. Those players include speculators, CTAs, which are the commodity trading advisors, risk premia, algorithmic and high-frequency traders, and index traders. In this presentation, I'll be going over a non-commercial player participants briefly. The first type of non-commercial players is speculators. Speculators are traders who aim for short-term profits based on price movements. They include hedge funds, proprietary trading firms, and retail traders. Their market impact includes providing liquidity and trading volume. However, they can participate in amplifying volatility during market events. Their strategies include trend following, mean reversion, arb trading, and global cross-commodity flows. Now let's go over briefly over the historic market prices to pinpoint some points in history where speculators were kind of influencing the market. Now I find it interesting that weather is the most impactful signal for the biggest single day movements in the coffee futures market. So weather is responsible for the biggest single day movements in the market. And that is what basically happened in 2021. As most of you are aware, in 2021, we had the largest Brazil frost since 1994. And the market rallied from above 150 to around 160 to almost $2. We had this market rally, which is the impact of the frost, and this was speculating the impact of the crop that's gonna come later on. So on the event of the frost, the market rallied almost 50 cents based on speculation of the impact of the crop later on. Now later down the road in December, we had the crop assessment and the crop turned out to be lower and the market rallied again, but the market already priced in a big portion of the rally based on the frost event, which was speculating what's coming on later. We had the same event happen earlier this year where we had weather dryness in Vietnam. The weather in Vietnam was very warm and dry, and the market rallied based on the risk of a Robusta crop coming in lower. Now, although the weather in Vietnam recovered later on and we had a decent Robusta crop, the market already priced in a rally based on speculation. Now, the next type of non-commercial traders is commodity trading advisors, CTAs. Those are systematic traders which trade based on price trends and those types of signals. They use technical and algorithmic approaches, and they aim to diversify their portfolio across commodities, currencies, and indices. Their impact on the market includes reinforcing the trends. They aim to stabilize or destabilize the market based on their concentration. And their strategies include trend following, volatility breakouts, and moving averages. Now, if you look at the historic market prices against the CTA position in the market, we see that the CTAs are heavily invested when the market has big market moves, and they tend to liquidate their position and do profit taking around the highs, which kind of explains why they are almost flat at this point, because at the highs they tend to reduce their position as a proportion to every price movement. The next type of non-commercial players is risk premium. Risk premium are traders who capture systematic risk premium to diversify their portfolio based on steady returns. They include pension funds and endowments and foundations. Their impact on the market includes stabilizing the market because they use systematic approaches, and they tend to have an impact in correlating the market with other financial markets since they invest in more than one market. Their strategies include momentum, carry, and volatility. So basically, they invest based on a market structure. So the way you can look at their strategy is like a basket of different commodities that they would look at this. They would invest in each commodity based on the structure being in backwardation. The next type of non-commercial players is algorithmic high-frequency traders. Those are traders who exploit ultra short-term inefficiencies in the market. They use high speeds of trading, and they use this for that. They execute sophisticated algorithms and statistical strategies. Their impact on the market enhances the liquidity of the bid-ask spreads. However, they increase the short-term price volatility, particularly during the market shocks. Their strategies include sophisticated algorithms, ML strategies, R trading, and momentum ignition, and other strategies. Now, the last type of non-commercial players is index traders. Those are traders who have long-only strategies for long term. They include investors like pension funds, ETFs, and S&P, like BCom and S&P. Their features include systematic rolling for their positions. So basically, they would invest in a market and they would hold their position for a period of time, and then they would roll for their position for across the contract months. And they would, as a result, increase the roll yield. So the rolling of their position is based on the entry level and the price of the market at that point. They would rebalance their portfolio based on profit taking for the position they set in at the point of the entry versus what the market is at the point of the rebalancing. To finalize our discussion about the non-commercial players, I would like to discuss a case study, which is basically why we're trading at the decade highs at this point. Now, this rally, which is the reason why we're trading above $3, is basically started in November. Now, in November, the market was in backwardation. Now, the market has been in backwardation for a period of time right now. And by the backwardation basically means people who hold the physical position in the coffee market pay a premium for holding this position. This increased financing costs of trading coffee, and that's why roasters then resorted to using hand-to-mouth buying strategies. So roasters were not planning their inventory ahead of time, but they were buying their coffee when needed. Now, this strategy works fine in normal market conditions. However, this strategy backfires when the market is volatile, which is basically what happened in November. In November, the market was pricing in uncertainty around EUDR. Many players were uncertain about their readiness to implement EUDR as of this year, which caused the market to start rallying and become very volatile. Now, although EUDR happened to be pushed for 1 year, however, the market kept on rallying because we were very close to first notice day. First notice day represents the last day where roasters have to put their positions to receive their coffee on time. Now, this presents a deadline for roasters, which everyone in the market was aware of, and many non-commercial players and speculators participated in buying the market because they were expecting a rally due to this dynamic. The rally did happen because roasters had to come in at their last moment and buy the coffee at a high, and they caused the market to rally even higher. Now, this augmented level reaching 270 hit momentum triggers for systematic buying. Some systematic levels were set at 270, and when the market hit this level, those triggers were enabled, and this caused even more buying. So the market rallied even higher, and we reached a $3 level. $3 is a significant level, as Keith mentioned before, for hedge lifting and reinitiation. Many holders of physical coffee had to stop their exposure in the market and lift their hedges at this level because it was super painful to take this margin loss. This hedge lifting was later reinitiated because we kept this market at this level. The market was kept on rallying, so the hedge lifting and reinitiation was run and tracer dynamic where they had to put their hedges back again, which caused the market to be volatile and oscillate around above $3. Many players in the market are implementing many risk management strategies to manage their exposure to a high volatile market at this point. It happens now that we are in December. December is the point where we get crop tour numbers, Brazil crop estimates, which Keith went over earlier, and the fact that earlier this year the weather was not optimal for the Brazil crop resulted in the crop being lower than expected. The fact that the Brazil crop is lower than expected is causing the market to have more uncertainty and more fear regarding what's available in coffee, in Brazil coffee, and this is causing and stay volatile and uncertain. So this is long story short, top level of what caused the market to reach these levels since November till the day we're trading at today. Now, I would like to finalize the presentation by reminding everyone in this call that coffee is much more than a product. It's a value chain that impacts the livelihood of millions of people around the world. And it's important to keep that in mind when we're trading at these high levels. And thank you.
Thanks, Zahraa. Can you unshare your screen, or do I need to do it for you? There we go. Okay. So thank you both again for contributing. I want to open the floor to questions. I see there's some coming through now. If anybody has a question, you can put it in the Q&A box, and we'll address it. The first one is, how do you calculate coffee demand? Oh, it's gone. I think Keith answered it. Okay. Does anybody else have any questions? You can also raise your hand and we can unmute you and you can speak to everybody in the audience. No? Oh, yeah. Wait, I see. Gary, I saw you raised your hand. Do you want to speak? I'll let you talk.
You hear me?
Yeah, you're good. Go ahead.
Good. First of all, thanks a lot, Zahraa and Kate, for the presentation. It was super insightful. Kate, I wanted to see how you would explain or interpret the COT move in the non-commercial Arabica from 78,000 lots to 96,000 lots in the spreading.
Yes, the spread position changed from 78,000 lots on the 3rd to 96,000 lots on the 12th, and the front spread dropped 70 points. I'm not sure I can give you much insight into that. I think actually Zahraa might have some points as well, because I imagine A lot of this is risk premia guys trying to trade this basis, trying to trade this switch basis mean reversion. That is what I would assume, but it is difficult to know that for sure. You're definitely offering a good point, because that is the largest spread position the non-commercials have had since July. It may mean that they're becoming a little bit more daring or courageous in this market, but it also may mean that some kind of signal has given them expectation for something with regards to mean reversion, or maybe they are seeing the exports out of Brazil to Antwerp that the rest of us are seeing, and are assuming that's going to mean something with regards to the front switches, and are trading them accordingly. It's difficult to anticipate exactly what's going on, so I guess I've given everything I assume. I hope that's helpful.
Okay, thanks, Gary. And the next question that we have is for Zahraa. Can you explain how quantitative traders work with physical traders at Sukafina?
I would say the fact that we have different departments at Sukafina, having quant traders, having physical traders, having derivative traders, provides the kind of diversity and encourages conversations from people with people from different backgrounds and different perspectives on things. Because the market, although we're trading a physical product, which is coffee, the market does actually sometimes get affected or follow a trend that's basically a technical signal. So the conversation between people from a technical background and people from a physical background helps us take better decisions in putting our positions in the market, and for risk mitigation, and for overall decision making. So I think diversity is always the merrier the better.
Okay, thanks. And then we have one for Keith. Keith, what was your estimate of the internal blend Arabica versus Robusta in Brazil, and how do you expect that to evolve going forward?
This is a very good question. And in fact, while the quantum of overall total coffee may or may not be in surplus in 2025, the internal blend in Brazil is going to be very much the key for shifting the supply from Arabica to Robusta, et cetera, et cetera. At the moment, what I generally do is I take what the arbitrage is in Brazil, that is the local arb between Robusta, between Conilon and Arabica, and I project that forward. At the moment, I'm using 45%, and that is projected then going forward. Every month, when I have a new average arb, that is adjusted, and I can say that with the December arb, 240 reais more than the November arb, we can only assume then that there is going to be there will be a change in that blend share moving forward. So that would then change the whole dynamic with regards to the Arabica Robusta supply deficit moving forward. So at the moment, I'm using 45%. That's 45% Robusta inclusion in local roasting ground consumption.
Okay, we have a few more. I guess this one could be from either of you. Can you explain the commercial index short at 50M contracts, largest ever, and what could be the other side?
Well, I'm not sure I can explain that, because I guess 50M is the net position. So 50M was the net position last week. That's not the most ever. It was 53,000 lots about 10 weeks ago. I can only say that basically it's been a function of the fact that the index were buyers the last couple of years. What I mentioned and what Zahraa has also mentioned is that in January, the index guys in the reweighting of the balances are supposed to sell somewhere between 14 and 16,000 lots. So we should see that net position go from 50 to 35. Generally, that's not correlated with prices historically, but it is chunky at 15,000 lots. Yeah, I don't know what could be on the other side. I don't know. Well, longs, I guess. Other spec, I suppose, or no, shorts. So other side would be the producer short at 150,000 lots, probably.
Yes, I agree to what Keith mentioned. I think index rebalancing would come in Jan. We did hit a net dollar value of index at a high 2 weeks ago, which caused a bit of selling, which can be explained as index rebalancing and can be explained as hitting a high level and then recalibrating. But the main rebalancing would happen in Jan, and the numbers, Keith, I agree with the numbers that Keith mentioned.
Okay, the next one, I think, Zahraa, maybe you can take this one. Given the current situation and factors, can we expect that the market will continue to be inverted and that prices are there to stay at current high levels for a longer period of time if demand is not breaking away?
I think the market structure is a subject of many influence of many factors. Of course, supply and demand, and as Keith mentioned in his presentation, as I mentioned earlier, it's also subject of certified stocks. So all those come in play when we're discussing market structure. We are having a build inside in certified stocks, which might affect the structure of the market. However, demand and supply are still a question mark until Jan. As Keith mentioned, as we are at Sukafina, we do have our crop surveys happening in December and Jan and so on. The certain crop numbers and the certain demand numbers are yet to be determined. Many different opinions regarding demand being steady, being at a surplus, or economy affecting demand and slowing on demand is very debatable. And I-certified stocks is a big player into defining if the market's going to be in carry or backwardation. So, and December is not really the time to decide on what we see in the market structure coming on this year. But I would say keeping an eye on these three, demand, supply, and certified stocks, is the key for how the structure is gonna correct or will stay in backwardation.
Okay, and I think this is the last one that I'm seeing now. It says a cup of coffee at the supermarket is still very cheap. Roasters have enjoyed good business for years, and producers have been on the losing end of the supply chain. Why would 5 cents be a bad outcome for the market as a whole? I'll let either of you
I
take
like
that one and debate
the
it.
anonymous attendee.
Yeah.
I wonder who. Well, my perspective on that is very cheap. Cheap is very relative. I don't know if you can say coffee is still very cheap. It depends on where you are and what coffee you're buying. But I think many people have suggested that it is no longer very cheap. I don't know what 5 cents is. The market's up $1.05 over the last 5 weeks. So we are hearing that next year's retail prices will go up significantly to continue to have, for roasters to have a margin. It's going to be good in some ways because we can certainly establish the fact that for Robusta since 2023 and Arabica in Colombia and Brazil, at least for 3 years, and for the rest of the Arabica world, certainly for this last couple of months, producers are looking at profitable enterprises with regards to coffee, and that should encourage production, and we should see output increase. So the market is trying to correct itself. And therefore, it's trying to work. And I have no comment on roasters because I'm not one, and I don't know how comfortable they are. Yeah, I think the market is trying to figure out exactly what with regards to supply and demand, and therefore is trying to figure out a price that everything is efficient at. And that may mean more expensive coffee at retail, and that may impact demand. We don't know yet.
Yes, I agree. I don't think the consumer has really tasted the impact of a high price yet, because I'm not sure many roasters have transferred this price into the retail prices and to the consumer yet. So the impact of high prices on demand is yet to be determined this year if the prices are still at a high. As I mentioned in my presentation, it would be great to give back to the farmer, and that's one of our pillars at Sukafin, and that's what we very heavily invest in. However, I do see roasters struggling at these levels, and I think roasters struggling at these levels means that farmers won't really get the impact of this price because they won't be able to afford buying at this price. So until the balance sheet corrects itself, and until we have a balanced supply and demand dynamic, that's when we determine if $3 is even a fair level.
Okay, we have time for one more question, and I see Keith is typing an answer to another one, so we'll just take one more in the group. So it says, "Hi, Keith, do you have a view on the demand in China and its impact in either Robusta or Arabica?"
Yeah, that's an interesting one, because if we look at the global world and we split up the consuming countries and producing countries and try to anticipate demand in each of them, one country really sticks out with regards to growth in demand, and that is China. They have been importing quite an amount of coffee, significant amount of coffee from Brazil and from mild origins as well. It's difficult to pinpoint exactly how much is sitting still at ports and free ports in China. We note that exports to China and imports into China are two different numbers, suggesting there's a lot of coffee sitting in some warehouse in some free port somewhere. What I can say is that growth is significant. It's coming from a very low figure. So while we are seeing double-digit growth, and it is starting to become a measurable amount, especially given the exports out of Brazil, it does seem that they have increased and filled out the supply chain initially at the beginning of the year and have slowed down significantly since. What I can say is that we don't think that the full exports to China are actually all demand. We are noting that there is tens of thousands of coffee shops opening up on China on a regular basis and trying to track all of the new stores, etc. We also note that it is a market that is very price oriented. So what I can say is this: Chinese growth is significant. It is one of the largest growing countries in the world with regards to coffee demand. Needs to be watched with regards to how much is going versus how much is actually being consumed, and needs to be watched in 2025 if prices stay this high, because we wonder if there is going to be a drop-off in demand if they need to increase the retail prices there, where people are starting to get used to coffee, but used to it at a very cheap level.
Okay, great. Thanks, guys. So we're going to end it here. I want to thank everybody for tuning in. The recording of the session will be available on our YouTube channel if anybody wants to access it later. And also shameless plug for the SCTA Next Gen LinkedIn, where you can follow us and see the schedules for when we plan these and other events. It's all through our LinkedIn. So thank you, Keith and Zahraa, again. We really appreciate you being here and sharing with us, and I wish everybody a good evening.
Thank you.
Thank you. Goodbye.